Very good evening to all of you. On behalf of Auditing and Assurance Standard Board of Institute of Chartered Accountants of India, I welcome you all in today's 150th CP program organized by AASB of ICI this year. As it is our immense pleasure to share with you that today we are organizing 150th CP program for this council year. And the topic again is very relevant, and we have covered all the sectors. And today we are going to we have taken Forex, key audit consideration while auditing the Forex transactions. And in order to tackle this very important sector, we are having with us very eminent and very known to all of us, CA Lokesh Gupta ji. So on behalf of AASB of ICI, I extend my warm welcome to you, Lokesh Gupta ji, in this 150th CP program organized by AASB. We are also having very two respected, very learned members, very respected from our own chartered accountant fraternity, C. Ashwini Singhal ji and CA KK Jain ji. Both are moderators of today's webinar. Ashwini ji, warm welcome to you on this 150th webinar organized by AASB of ICI. Respected KK Jain ji, warm welcome to you also.
Thank you, sir.
Due to the certain meetings as well as visits, Honorable Chairman sir and Honorable Vice Chairman sir both are stuck up in the another engagements and meetings. So they are also attending some other office meetings. So that is why I'm taking this liberty to start this program. So before we further start, I request our today's learned moderator as well as very respected Honorable Chairman sir has already joined. Good evening, sir.
Good evening, Anil ji.
Sir. Sir, we are live, sir. We have just started, sir. Kindly start the proceedings, sir.
Yeah. Thank you. A very good evening to all of you, friends. I welcome you to the AASB webinar on the audit of the Forex transactions. Friends, AASB has been organizing programs on various specialized topics, and today's topic is audit of Forex transaction. Our esteemed speaker for the day is CA Lokesh Gupta, who's taken many programs for his shoot. As is evident, you can see in his background, there are so many mementos which are there. Thank you, Lokesh ji, for giving your acceptance and your valuable time for the shoot. And we have our two very esteemed moderators, Ashwini Singhal ji and KK Jain ji. Both have a vast audit practice experience dealing with the various issues involved in the audit. And I'm really thankful to Anil Lalji also for bringing speakers and moderators from such diverse backgrounds. We can see books in the background of Ashwini ji that shows the kind of knack that our members have for the further studies. And we really, Ashwini Singhal ji comes from Rohtak and KK Jain ji comes from Sonipat. So it is heartening to see our members from smaller towns also participating in the various programs of the institute. Thank you to all of you, and with you, back to you, Anil.
Now I request... yes, sir. Please, Ashwini sir, please start the proceedings of today's webinar.
Welcome. I welcome all the participants of today's seminar. वेलकम संजीव सिंघल जी, वेलकम लोकेश गुप्ता जी, वेलकम अनिल जी। मैं तो एक बात जरूर कहूंगा आपको देख के ताबीज तो गले में बहुत पहन के देख लिए, आराम तो आपके दीदार से ही मिलता है। नाउ मेरे हाथ में जो लोकेश गुप्ता जी का प्रोफाइल है वो इतना फैंटास्टिक और इतना लंबा चौड़ा है कि Lokesh Gupta ji did his CA in 1998, then LLB from Delhi University in 2001, then DISA and Forensic Audit in 18. He is practicing partner with Shyam S. Gupta and Company. Experience in audits, various branch statutory audits for more than last 20 years, conducting concurrent audits, stock audits, internal audits, public and private sector, specialized audits in banks such as currency chess, conducted audit of outsourced area in banks such as agencies involved in refilling ATMs, experience as guest speaker on statutory audit and concurrent audit of bank branches at a large number of seminars organized by branches and study circles, speaker on FEMA, FCRA and internal taxation, provided training to bank staff also. I was reading के बैंक के स्टाफ को भी ट्रेनिंग देते हैं. Fantastic, sir. Contribution to professional development. Contributed as a member of group on the certification course on concurrent audit of banks. Present faculty on certification course on concurrent audit of banks. Contributed as a member of group for audit checklist for concurrent audit of banks and revision of Ghosh and Jilani committee, sir. Experience in other professional areas like conducting statutory and internal audit of large number of units, both public and private sector, consultancy, especially in FEMA and international taxation, which is today's topic. Fantastic, sir. Lokesh ji, welcome, sir. Now I will request Lokesh Gupta ji to continue today for today's webinar. Lokesh Gupta ji, over to Lokesh Gupta ji, please.
Good afternoon, everyone. Thank you, Ashwini ji, for this introduction of mine. Sanjeev ji, Chairman WASB, Anil ji, and my moderators here, Ashwini ji and KK Jain ji. It is always a pleasure when you are invited to your alma mater, to institute, for sharing your views on any of the topics. I have been fortunate that the institute have been calling me, have been considering me educate to share my views with other members. And this is one such occasion when Anil ji actually called me up to ask me for this session. I thought it must be easy because Forex being an area where we work on a daily basis, I thought it would be very easy to actually do this session. And by the time I started preparing for it, I realized that I have too much to deliver. And frankly, a time would be something which would be a paucity. And of course, then it becomes what to include and what not to include. Because Forex per se is an area which is very vast, includes a lot of elements. And of course, as you keep on working in this area, you realize a lot of pitfalls, a lot of areas where there's a concern. Sometimes we ignore them, sometimes we are not aware of it. I do not work on it, but of course, having worked in this area, I feel that I have a lot to share to the members in terms of what I have felt, what I have gone through during the course of audit in this area. So without wasting time, I'll straightway jump to my presentation on this. Anilji, is it visible? The PPT?
Yes, sir. Yes, sir. Yes, sir. Fine.
Okay. So starting off with my disclaimers, the PPT is basically for a general training purpose and does not constitute a professional advice. And this does not really reflect the views of the presenter or the ICA on this issue. So please do not take it as a professional advice. We may have shortened a lot of things for the purpose of making it more presentable. Now, when I look at the area of audit under Forex, I thought what should be the areas we should be able to cover within this presentation, and what should be the most important areas which we should keep in mind while we are auditing a Forex area for any enterprise for that matter. So I thought the regulatory landscape being one of the most critical, because this is one of the technical areas where there are a lot of rules and regulations which are applicable to the Forex area. Sometimes what I have seen, even in the concurrent audit, when I go for training as a concurrent, in the concurrent audit code, I speak on this area only on the FEMA side. So what I've seen is sometimes a lot of members do not have the practical exposure to this area. So when there is an issue relating to this area, they find sometimes that they are not fully equipped to handle this area. So very important is to understand the regulatory landscape, which of course the most important being the FEMA, the Foreign Exchange Management Act 1990.
Hello.
Then of course when it comes to import and export.
Hello.
Hello. Is there an issue?
No, sir.
Anil?
Continue.
So in case of imports and export, the TFT guidelines become important. Then I thought, of course, when we talk about Forex, it is not only the regulatory mechanism in terms of FEMA and the guidelines which enables us to do a Forex transaction. Then the Income Tax Act. So when I look at the Income Tax Act, of course, withholding tax being one of the most critical areas. Then we have equalization levy. Then we have various regulations which are applicable to the Forex area. In the one of the areas which we have recently faced is what we call as a significant economic presence and the transfer pricing regulations. So we'll touch upon these areas in short. I'll give you food for thought basically. I cannot actually do justice to any of these areas in complete. We'll try and understand these areas and understand its importance to the audit area. And then we'll talk about the goods and services tax in relation to where we do a Forex transaction. So there might be some issues relating to specifically in relation to GST in relation to the reverse charge under GST when it comes to the Forex transactions. Then, of course, proper recording the books of accounts. So the accounting standards, AS, Ind AS would become important. Then the income tax has given their own set of regulations. So ICDS would be important, and Section 43A and 43AA of the Income Tax Act, which specifically deals with the foreign exchange fluctuation, which is an integral part of any forex transaction which an enterprise would do. So we'll touch upon them in short. Then, of course, once we have done a proper recording, then of course the verification of transaction, which is the most critical part for any auditor. So the evidence to be collected, we'll touch upon SA 500 and 505 for that matter, and the proper appraisal to arrive at an audit opinion. So 700, 701, 705, and 706 we need to be aware of. Of course, it is not only in relation to Forex. These are in any case important for any auditor when they are going for an audit to form a proper audit opinion, because the ultimate result of any audit is an audit opinion which comes in form of an audit report. So proper drafting of that audit report and the applicable standards of auditing becomes very important for any auditor to take care of it. Now, starting off with the regulatory landscape, because I think that's the most important areas. What I thought was basically that we'll touch upon the various aspects of what we can do under Forex, and then touch upon as to what is the importance to us as an auditor and what we need to take care. So trying to bring out the regulatory aspect plus the importance for us as an auditor when we go for an audit for an enterprise, what importance these regulatory aspects hold to our audit actually. We'll try and do it in that fashion. Now, when we look at Foreign Exchange Management Act, now this act per se is not a very elaborate act, unlike the Income Tax Act, which might take up a huge book in our shelves basically. The Foreign Exchange Management Act is a very small act per se, and it has very few sections actually when it comes to the regulatory guidelines. But it does not mean the guidelines are very limited. The guidelines are very elaborate, but they do not form part of the act itself. They come as way of a rule making powers. Now, rules making power are now divided between the central government and the Reserve Bank of India. So both of them give rules under the Foreign Exchange Management Act. So basically, the act is such that the top tier is for the act, then comes rules made by the central government, then come regulation made by the Reserve Bank of India, and then there are various master directions and notification issued by the Reserve Bank of India, which are basically for the purpose of understanding the implications of what the rules and regulations state and understanding what is the view of the regulator here. What is the understanding of the regulator as to the various rules and regulation which has been incorporated as part of the act. Then there are circulars issued by DGFT, which would be specifically in relation to where we do trade transactions, imports and exports, basically. Then we have certain FDI guidelines which are more applicable to a banking company, but because the banking companies are required to follow it, sometimes become important for us to understand that when it comes to the audit of a forex transaction. And then at last we have ICC. ICC is International Chamber of Commerce. They have given certain standards, 6 of them which I have stated here, which are most commonly used by banking companies, specifically when they are dealing with forex transactions. So like trade transactions, basically uniform rules for collection would be applicable. When they issue a letter of credit or how LC is to be dealt with, then uniforms, customs and practice for documentary credit UCP DC 600 becomes important. Then in relation to guarantees, URDG 758 becomes important. Then international standard banking practice for examination of document under documentary credit ISBP 745. This is in relation to the a concept wherein we issue standby letter of credits. And then international standby practices, uniform rules for bank-to-bank reimbursement under documentary credit. So these are some of the important rules, more important when you are auditing a banking company, but of course equally important when we are auditing a company which are engaged into activities where they are using LCs and they are sending documents on collection and all. So these standards may become important to understand the right and liabilities of the organization or the banking company in any of these transactions. Now, when we look at forex transactions, this most important, when I look at FEMA, the most important point here is that we need to understand that FEMA divides all forex transaction into 2 parts. One is what we call as a capital account transactions, and another what we call as a current account transactions. If you look at the definition given under the Act, capital account transaction basically would alter the assets and liability, including contingent liability of a person resident in India or assets or liability in India of a person resident outside. So what affects basically your balance sheet items would be constituted as a capital account transaction, and what does not amount to a capital account transaction would amount to a current account transaction. And specifically, they have included payment for current business services, short-term banking and credit facilities, payment due on interests on loans, net income from investment, remittance for living expenses of parents, spouse, children residing abroad, expenses in connection with foreign travel, education, and medical of parents, spouse, and children, etc. They have specifically included in the current account transaction. Why are we even speaking about? Why it is so important for us to understand what is a capital account transaction or what is a current account transaction? The reason is, if you look at FEMA, the basis of the act is, and if I say as a thumb rule, the current account transactions are allowed, are permitted, unless until they are specifically somewhere the rule or the regulations state that they are not allowed or they are regulated or you require a specific approval. So they are otherwise allowed. They may be regulated in terms of how much you can do it. So there may be a restriction on the amount of how much you can do it, but per se they are permitted transactions. On the flip side, the capital account transactions are those transactions which are not generally allowed. They can only be, you can do a remittance only for the purpose of capital account transaction as per the rules and regulations stated there. So they are not per se allowed. Specific rules and regulation exist as to the extent and amount up to which you can do a capital account transaction. So first thing, when I look at a forex transaction for any enterprise is that the transaction which I am looking at, whether it amounts to a current account transaction or a capital account transaction, was that would only determine what rules are to be applied to that transaction. Okay. So the next point would be, if I look at current account transaction, capital account will specific cover the most important areas therein. So it has a foreign exchange management current account transactions rule 2000. It provides for 3 schedules, Schedule 1, Schedule 2, and Schedule 3. Schedule 1 tells you transactions which are prohibited. Schedule 2 tells you transactions which require prior approval from some ministry or department. And Schedule 3 are permitted transactions. So Schedule 1 and 2 are specific lists. Schedule 3 is basically the residual list. What does not fall in Schedule 1 or 2 would fall in Schedule 3. So these are permitted transaction per se, and there may be a cap as to the amount which up to which you can do it, but per se you are allowed to do these transactions. Why it is so important for us to understand again? Because though current account transaction, if I see a transaction, I see whether it is under current account. Yes, it is under current account. Now whether it is permitted or not permitted, that's the first point. So we'll have to look at the schedule, understand the schedule, and see whether we have done a transaction which was prohibited. So this is the list of the prohibited transactions which cannot be done. So in case you find a transaction done by any enterprise which is within the prohibited list, it requires you to report that transaction as a prohibited transaction. These transactions cannot be done, right? So again, referring to SA 250, which talks about compliance of all rules and regulations, auditor has to verify that. So this becomes very important for us to check whether any such payments has been done by the enterprise which is in the prohibited list. Okay. Secondly, it may not be prohibited, but it may require a specific approval from somebody. So if you see the schedule 2, on the left hand side, you see the purpose of remittance, and on the right hand side, you see the permission is required from which person, which authority would give you the permission for doing any such transaction. Like for cultural tour, in case somebody is going for a cultural tour, then the payment can be released only after the permission has been obtained from the Ministry of Human Resources Development, HRD. Okay. Similarly, is in case of multimodal transport, remittance for hiring charges for transponders by TV channels, internet service providers. So in that case, Ministry of Information and Broadcasting and the Ministry of Communication and Information Technology. So approvals from both of them would be required. So second is whether they were permitted. If they were permitted, whether approval was required. If they fall in schedule 2, the approval would have to be taken before the transaction can be done. Otherwise, it is an unauthorized transaction. Okay. Then would come into schedule 3, which is again, as I said, is does not constitute an exhaustive list, because whatever does not fall in schedule 1 and 2 would fall in schedule 3, right? So it is not possible for anybody to devise a exhaustive list of schedule 3. I have mentioned certain transactions with the limit specified therein in the law as to how much you can do it. Per se, they are permitted. Only a limit has been marked against them that you are allowed to do this transaction up to this specified limit. Okay. But as we discussed, there can be hundreds of other transactions falling in Schedule 3, which I may not have mentioned here. But of course, they would fall in Schedule 3 if they are not specifically in Schedule 1 or Schedule 2. Okay. So remittance for traveling abroad, whether it is for leisure, whether it is for business, whether it is for some medical reasons, whether it is for education, would fall in Schedule 3. Similarly, payments made for imports would fall in schedule 3, right? So these are some of the transactions which fall in schedule 3. So when I look at a forex transaction, first thing is to look at whether it is a current account or a capital account transaction. If it is a current account transaction, please look whether it should not fall in schedule 1, which is the prohibited list, schedule 2, which requires a specific approval. If they are not in it, then it is under schedule 3. You are now only looking at the limit specified under FEMA for that transaction per se, because it is per se allowed. The limit has to be only verified by you. Now, when I look at the limit, of course, we cannot skip unless until we talk about a scheme called as a liberalized remittance scheme. Now, the scheme is now very famous, made famous by the fact that there is a TDS provision which exists, TDS TCS provision exists under the Income Tax Act. In relation to this scheme, there was a lot of hue and cry also when the TDS rates were increased from 5% to 20% recently. So this scheme is there. This is applicable only to individuals. So anybody other than individuals is not covered by the liberalized remittance scheme, right? So there might be a question whether a sole proprietorship business, whether they can enjoy the benefits of this scheme. Yes. So RBI has clarified that in case of a sole proprietor, because there is no difference between the sole proprietor and the individual, they are covered by the liberalized remittance scheme. What benefit this scheme give is that they give you a limit of USD 250,000 per financial year per person for remittance outside India for any current or capital account transactions. So you can do a combination of both. You can do current account transaction also, and this scheme, the advantage is you can also do a capital account transaction also, up to the limit of USD 250,000 per person per financial year. So of course, it allows you to do the transaction. It gives you an upper limit up to which you can do the transaction. The limit is per person per financial year. It is not per purpose. Okay. So it does not mean that, say, for travel, I can use USD 250,000, and then maybe for again for say doing some other transaction, maybe doing a buying a portrait or buying some goods from outside India other than business purposes, I can again use USD 250,000. So that is not allowed. It is per person for us financial year for all the purposes combined, whether it is capital or current account transaction. Okay. Of course, as I told you earlier, it is only applicable to an individual. Non-individuals are not covered by the scheme, and it is only applicable to a resident individual. So non-residents are not covered by the scheme. Only resident individuals are covered by the scheme. It provides for mandatory holding a PAN number. And in case you are dealing with a capital account transaction, then it also provides for a bank account for a minimum period of 1 year, or in case that is not there, then the IT returns, etc. for the latest period. It is a mandatory requirement. Now, of course, because this scheme is also under Schedule 3, so Schedule 1 and Schedule 2 transactions you cannot do. You cannot do margins or margin calls to overseas exchange, overseas counterparty. This is something which is very important. I have personally received calls from persons who say that you can actually do transactions into currency market outside India, speculative transactions. So I asked them that whether it is allowed under the current guidelines in India. So generally the response was that it may not be allowed and we may come out lazy transaction or something of that sort. So this is something which is specifically not allowed. Please be very careful. Margins or margin calls to overseas exchange, overseas counterparty is not allowed. Though under the liberalized remittance scheme, we'll discuss it in detail going further when we talk about transaction in relation to overseas direct investment. Though it is allowed that you can invest into shares and securities outside India, but margins and margin calls per se is not allowed. And purchase of FCCBs, foreign currency convertible bonds issued by Indian companies in overseas markets, uh, that you cannot purchase from money transferred to the liberalized remittance scheme. Then remittance for trading in foreign exchange abroad. So you cannot do remittance for trading in foreign exchange abroad. So this is specifically again a limitation under this scheme. Then throughout FEMA, if you actually look at one, remittance directly to Bhutan or Nepal is not allowed. Why? Because in case of Nepal, whether you are doing any remittances, clean outward remittances like this case, say for travel, etc., for medical, for any such purpose, even for imports or even for investment into Nepal, you are not allowed to use foreign exchange. So this is something which we have to keep in mind. In case of Bhutan, again, for travel, etc., you are not allowed to use foreign exchange. Though investment can be made in Bhutan in foreign currency, but otherwise, for other reason for even imports from Bhutan, you are not allowed to use foreign currency. And then any country identified by FATF as a non-cooperative country, or what we call as in the local parlance, we call it as a blacklisted country. So FATF, you will be aware, is a financial action task force. It's a international body which is basically looking at the KYC, the AML compliances at the level of territories, at the level of jurisdictions, at the level of countries, basically. So any country which falls within that list of blacklisted country are specifically debarred from receiving any foreign currency, or they basically FATO then advises countries not to deal with these countries. At present, the name of basically three countries is appearing the blacklisted countries. One is Iran, second is North Korea, and there is Myanmar, which is there in that list. So most of the countries in the world, once any country falls within this area of FATF, any country which is blacklisted by FATF, they would stop doing any work with them and stop doing any business with them. This appears here also and would appear nearly everywhere wherever we go and study. So whether it is imports or whether we are looking about investments in any country, there also the same rule would apply, and we'll discuss it once we go to that area, how it actually applies and how we need to be careful as an auditor also when we are auditing such an organization. And then there is a list of individuals and entity which are posing significant risk of committing acts of terrorism, which is separately advised by the Reserve Bank of India. So you cannot actually also remit directly or indirectly to any such organization. And then, of course, the bank have to do in case somebody might think of splitting the transactions and making transactions done from two different banks or two different entities and somehow breaching the limit. So there is a T+1 base reporting, and then there is a monthly reporting which goes to the Reserve Bank of India from the banking side. So, so when I look at it from a banker's perspective, they are very concerned about the source of fund, where the funds are coming, where the remittance is happening. Because the funds can go move under this liberalized remittance scheme even as a gift to a non-related. So it becomes very critical for the banking company to look at the source of fund to ensure that there is no risk as to the money laundering aspects. And as an auditor to a banking company, sometimes it becomes critical for us to also verify these how the bank is actually verifying this area, how the bank is basically generating any exception report or verifying such cases where there is a potential risk of a money laundering. So this is one of the most important areas which we have. Now, somebody might ask in case there is a company which is doing some import. So what is the limit there? So there is no limit, sir. This falls under other capital account, other current account transactions, and no specific limit has been prescribed. So as far as import goes, there is no specific limit as to how much imports you can do. Of course, there are certain regulation in terms of submission of import evidence and everything. But per se, there is no limit as to how much imports you can do. Okay. And in case you are not specifically covered by LLS, then also you can do current account transactions, which are like private visit to any country, gifts or donation, going abroad for employment, emigration, maintenance of close relatives abroad, travel for business, conference, specialized trainings, meeting expenses for medical expenses abroad, attending to a patient going abroad for medical treatment, studies abroad, and similar kind of current account transactions you are allowed to do. So this is the basic limit. Then you can breach this limit in case of medical treatment and studies and immigration also, subject to submission of certain evidences to the bank, and then you will be allowed to actually go beyond this limit also in certain cases. Okay. Now this is where you are doing a remittance, whether it is for travel, you are going for a travel, you are maintaining your somebody abroad, maybe a son going or a daughter gone for education, or somebody going there for medical treatment. So this is how you look at those limits. Now, suppose somebody from the company has gone for a business meeting outside, right? They come back, they have some amount of foreign currency which is left with them, which is unutilized. Now, how to deal with that unutilized amount? What is the regulation for that unutilized amount? Because why it is so important that in case you find that the company has foreign exchange which they are going to show in their balance sheet, in their financial statement, whether it is in compliance with the rules and regulation, whether they were allowed to hold that currency with them, the excess amount which they have taken. So they may have taken an amount they have not fully utilized. Generally, you will not utilize the full amount. So, what is the regulation in terms of whether you can hold that foreign exchange which you have brought back? So, the RBI guidelines is very clear that in case you have returned to India, you have some unspent foreign currency lying with you. So, you have got 180 days to decide what to do with that unspent amount. In case you want to utilize, say you feel that you will do another business travel, within the next 180 days, you can actually use that foreign currency there. There is no restriction. In case you feel that you will not be able to utilize the amount within the next 180 days, then you have to go and surrender it to the bank, the authorized dealer, any authorized dealer, it may be a bank or otherwise. And the amount cannot be retained beyond a period of 180 days, except for an amount of USD 2000, which does not include coins. So USD 2000, not including foreign coins, may be retained for a period beyond 180 days also. So this is the regulation. So when you look at, say, your company is basically for a foreign exchange transaction, the promoter or the director or some employee of the company is traveling abroad, look at the regulation and see whether they are in compliance, whatever amount was left unutilized with them, they have been utilizing it or they have been surrendering to the authorized dealer within the time specified under the relevant guidelines of FEMA in this regard. Okay. Now, very important when it comes to again foreign exchange transaction is that there is always a confusion regarding the residential status under the Income Tax Act. Let me add to that confusion by adding that the guidelines given under FEMA is different to the guidelines given under the Income Tax Act as far as residential status is concerned. Now, under FEMA, if you actually look at all those guidelines, the most important aspect is your residential status. Of course, the nationality also becomes critical in certain factors, but the residential status is the most important guidelines. So you need to be also aware as an auditor what are the guidelines in terms of who is a resident or a non-resident under FEMA, which is in distinction to the guidelines given under the Income Tax Act. Now, under the FEMA guidelines, it says who is a the definition of non-resident is very simple. It says that whosoever is not a resident becomes a non-resident. So, equally important is to understand that who is a resident. So, resident, the definition is given is that a person residing in India for more than 182 days during the course of the preceding financial year, but does not include. So, any person who resides in India for more than 182 days during the preceding financial year would be considered as a resident. But any person, so clause a person who has gone out of India, who stays outside India in either case, for on taking up employment outside India, for carrying on outside India a business or a vocation outside India, or for any other purpose in such circumstances as would indicate his intention to stay outside India for an uncertain period, becomes a non-resident. So because he is taken out of the definition of forex, of the resident itself. Now, let us understand it by an example. What is the importance of this definition and how it is distinctive to the definition given under the Income Tax Act? Say there is Mr. A who is a Indian citizen. He has been residing in India for his entire life. Now he has taken up some employment in say US. He has got a employment visa. He has an employment letter. He's leaving India for the first time in his life for the purpose of joining that employment. Now, under the Income Tax Act, the definition would require to check for his period of stay in India in the previous financial year, previous year, and then look at maybe the period of stay in the previous six previous years also. Here, the definition is such that the day the person leaves India for the purpose of joining that employment in US, even if he satisfies the condition of 182 days stay in India in the previous year, he becomes a non-resident on day one itself. Day one, he leaves India, he becomes a non-resident in India, irrespective of the fact that he may have lived in India for more than 182 days in the previous financial year. So say somebody leaving India on 1st of December of any financial year, he has already lived in India for more than 182 days in the previous preceding financial year. But then also, if he's leaving for the purpose of joining that employment, he becomes the non-resident on day one itself. So 1st December he leaves. From 1st December itself, he becomes a non-resident in India. That is the difference between the distinction between the definition between the Income Tax Act and the FEMA guidelines. Why it is so important for us to understand these distinction is because when it relates to any guidelines under FEMA, whether it is bank accounts, whether it is dealing with those persons in relation to the FEMA guidelines, the definition of FEMA would be important, would be the definition which would be applicable. So you need to be very careful about this definition. So similar is in case of a business or a location outside India, and in any other case, in such circumstances, as would indicate his intention to stay outside India for uncertain. And on the reverse side, clause B, it talks about a person who has come to India or stays in India in either case for on taking up employment in India, for carrying on India business or a location in India, and in any other case, in such circumstances, as would indicate his intention to stay in India for an uncertain. So this definition is very critical, I thought, to bring to the table so that to avoid any confusion. And please keep in mind when we look at the forex transactions that we are aware of this definition in total. Okay. Now, similarly, in case of NRI, NRI is a person resident outside India who is a citizen of India. And then we have a definition of PIO, which is a person who is non-resident and not a citizen of India, then and satisfying any of these conditions. I'm not it and understand. Now, equally important would be when we deal with transactions, they are specialized accounts when it comes to FEMA. So there's an NRE account, there's an NRO account, FCNR account, SNRR account, RFC, RFCD domestic account, then EFC account, Diamond Dollar account, and FCRA account. FCRA, of course, is not under FEMA, it is a separate act in itself. So we'll touch upon some of the relevant aspects of these definition, and it's important to the audit which we go through. Now, NRE account, non-resident external account. It is given to NRIs and PIOs only. So a person who is neither a NRI nor a PIO cannot open a NRE account, right? So non-resident external account. Okay. Eligible credits to a NRE account would be more important when we are looking at an audit from a banking company's point of view. So they allow credits to NRE account within the limited range which is allowed them to credit in the NRE account. But very important from the audit of a forex perspective is debits to a NRE account. Now look at a very small example where we have seen a lot of issues. Say you receive money from a person who may be your relative, or who may be even your son or your daughter. You may have received money in your company. That money has come from India only. So it is a local credit. It may have come through RTGS, it may have come through a check given to you. The money has come from debit to a NRE account, and you have issued shares to that person. Why so it is so critical? Why? What difference does it make whether we have issued such shares? The money has come from local shops, but because it has come from a NRE account, that money and the NRE account can be opened only by a non-resident. So that would amount to an investment in your company by a non-resident. NRE account being considered as an external source, this amount would amount to a foreign direct investment. We have seen cases where people have come to us not realizing that they have accepted foreign direct investment in their company. Why? Because the money flowed from the NRE account of some very close relative, say his son, daughter, or brother, or somebody very close to him. The money flowed from an NRE account within India and flowed to their account as in the current account in form of RTGS or a check, and they didn't realize that it amounts to a violation of the foreign direct investment guidelines, because that would amount to a FDI, and of course the FDI guidelines would be applicable. It may be permitted per se, but of course still there was a requirement in terms of filing of forms and applying to the Reserve Bank of India, which was not followed well. So sometimes very critical for us to understand what is NRE account, and then any because NRE per se, if you look at it, is considered an external source of funding. So when we look at the export guidelines also, you realize that money received from NRE account is considered as if it has come from from a foreign country. So it is considered as a proper source of receiving export proceeds also. So sometimes understanding the nature of account, though it may be more applicable, more important for a banking company or an auditor to a banking company, becomes equally important for us as a person who is not from the who's auditing a normal organization. Okay. Then we have FCNR account. Basically, again, FCNR account is considered equivalent to a NRE account. The difference between NRE account is denominated in Indian rupees and FCNR is denominated in foreign currency. So it is foreign currency non-resident deposit account. And NRE account can be in form of a savings, current, or a FD, RD account. FCNR account is only in form of a fixed deposit. So any money again flowing from FCNR deposit is considered as equivalent to a money flowing from a foreign location as an external source. And similarly, as in case of FCNR NRE account, any money such following may require you to follow certain regulation and ensure that the proper procedure is followed. Then we have special non-resident rupee account. This is will be very critical in case somebody is auditing a business entity which is not registered as a company in India, which may not be having any proper place of business. They are basically here for some specific project, specific work, and they are not looking at continuing further after that project is over. So they can open a SNRR account. Basically, it is denominated in Indian rupees in form of a current account only. And the name of the SNRR account is basically in the name of the business plus the name of the specific project for which they are opening the SNRR account. And the debits and credit and the balance in the account shall be incidental and commensurate with the business operation of the account. And the maximum tenure is 7 years for SNRR account, except for certain transaction like trade credit transaction like ECB, etc. And the balance in SNRR account shall be eligible for repatriation after payment of the due tax. And in case the person which is opening the account is an entity from Pakistan or Bangladesh, would require a specific approval from the Reserve Bank. So in case you are auditing any such entity, you should be aware as to the nature of account they are maintaining, what are the rules and regulations which are applicable to that such account, which is that one is very important that they cannot continue to maintain that account beyond 7 years. And the debits and credits in the account are basically meant for the purpose of that functioning of that project for which they are in India. No other debits and credits can be done to that account. So this you should be aware of. Then we have EEFC account. This account, you will see a lot of exchange earners, exporters having these kind of accounts, EEFC account. The full form is exchange earners foreign currency account. Now this account is in form of a non-interest bearing current account, but is denominated in a foreign currency. And any person might have multiple EEFC accounts also, right? So they can EFC account denominated in US dollars. They can have another EFC account denominated in say euro. So this way they can have multiple EFC account. What is the purpose of having an EFC account is, let's say in case you receive a remittance from outside India, and we'll understand how that process actually happens, is that you have to convert that amount into Indian rupees and credit your normal current account maintained in India. Now, what happens is suppose somebody is also into imports also and is in exports also. So the problem for him is that once he receives the amount, then that amount gets converted into Indian rupees. And when he has to do a payment for an import, again he has to do a reconversion of that Indian rupees into foreign currency. The problem with this is that bank does not give you the same rate for buying and selling, right? So bank has a margin, has a spread between what rate they offer you in case you are selling them foreign currency and what rate they offer you when you are buying foreign currency. That is the source of income for the bank. So one is you lose on their conversion charges. Secondly is that whenever you do a conversion, you actually also incur a risk in terms of foreign exchange fluctuation also. So these are the two reasons why it becomes important for any entity to have a EFC account in case they are into receiving of foreign currency as export proceeds, as exchange earnings. So what you can do is you can credit 100% of your exchange earning to this account. No credit facilities are allowed against the same. But the most important condition which you have to keep in mind is that whatever accruals have happened during a calendar month, say from 1st December to 31st December, whatever credits have been done to the EFC account of a person, they can keep that balance up to the end of the next calendar month, which is January. So January 31st is the maximum you can keep that balance. Either you can utilize that balance for any permitted activities to 31st January, or you will have to convert that balance into your normal Indian rupees, credit your normal current account for that purpose. So you cannot hold on to that foreign currency balance forever, except for any amount which you may have retained for a forward commitment. So say you give a documentary evidence to the bank saying that, see, I have to make a payment for this import. Say in the month of Feb, you tell them a approximate date. Say by 15th Feb we have to make a payment. So the bank would earmark that amount of funds in the EFC account for that forward commitment, and rest of the account balance would you will either have to utilize by the next calendar month, which is 31st January in our example, or you will have to convert that into your normal current account balance. This is important. Why? That sometimes we have seen that the customers continue to maintain this balance beyond that specified time limit. Even the bankers are following up, or the bankers also fail to follow up for the same, and this becomes a violation of the FEMA guidelines. So, as an auditor to a company which is maintaining a EFC account, you need to verify that the account has been maintained as per the guidelines given under the act. Then we have similarly RFC account, resident foreign currency account, more so important in case of persons, so we are just going to skip it. Then we have similarly RFCD account, then we have diamond dollar account. This is applicable for firms and company dealing in purchase, sale of rough or cut diamonds, precious metal jewelry with track record of at least 2 years, and average annual turnover of 3 crores and more. This diamond dollar account is quite similar in nature to EFC account, but is only in form of a US dollar account. It cannot be in any other currency. And of course, the condition which we discuss that whatever credits you have received in one calendar month, you have to utilize by the end of the next calendar month, or convert it into your normal Indian rupees balance and credit your normal current account, savings account, is applicable to a diamond dollar account. So in case you are looking at any person, auditing any person which is maintaining either a EFC account or a diamond dollar account, please check whether the account has been maintained as per the guidelines given there. Then, of course, we have FCRA account. FCRA, generally, when we look at and anybody who understands FCRA would say that it is basically in relation to these trusts and not profit making activities. Society is handling these kind of activities, not for profit making activities. Of course, yeah, basically FCRA Act actually applies to these organizations actually. But actually, if you actually ask me, there are certain areas where we need to be very careful that FCRA Act may have an implication beyond what you actually contemplate. If you look at the definition given under it, includes an HAF and includes an association company registered under Section 25 of the Companies Act, which is now Section 8 under the Companies Act 2015. But look at scenarios which I can tell you a few scenarios which becomes very important for us as an auditor. So after this COVID exercise, the problem was over. We got received calls from a few of the companies in India where they wanted us to advise that they have received certain amounts or certain equipment from foreign entities. Maybe somebody they were dealing with, they wanted to supply certain equipment. So in one of the cases, somebody approached us asking us that they have received certain equipments, oxygen concentrators from somebody as a gift, and they were required to distribute it to various hospitals free of cost. Now they were only receiving it for the purpose of distributing it to the hospital. So they were concerned whether that receipt of equipments free of cost from a foreign company would amount to they getting covered by the FCRA Act. So these kind of issues sometimes arise, which needs to be taken care as an auditor, whether there is any liability under the FCRA Act, whether you are required to get any registration done, or whether you're required to do any compliance done in such cases. So these guidelines become very important. And now even under FEMA, in a lot of cases, what we are seeing is there is a cross-referencing happening. So under FEMA, they are cross-referencing it to the guidelines for FCRA. So that so they are saying that this issue would be covered by the FCRA guidelines. So you need to be certain times aware of the FCRA guidelines also and its impact on your organization, right? So this is again an area which where I feel that sometimes we take it little lightly in terms of thinking that it is not applicable to entities which are basically into business, and it is only for non-profit entities, which may not be exactly in line with what the law has intended. Okay, and then of course we'll understand how a flow of transaction for import and export happens, and then we'll try and understand what can be issues in relation to trade transactions in case of our entities where we are doing an audit. So how money flows for a say Indian bank receiving funds or making payments abroad, how that flow of money actually happens. So they use an account called as a Nostro account, and there is an account also called as Nostro account, which is used for the purpose of receiving and making payments. So Nostro account is nothing that Indian bank opens account with foreign entity, foreign bank abroad. So say SBI opening an account with Bank of America for the purpose of receiving funds and making payments abroad. This account, SBI would state, is a Nostro account for us. And this account of SBI with Bank of America would consider this account as a Nostro account. So basically, Nostro account is our account with you, and Vostro is your account with us. Okay. So this is one of the method through which payments are received and paid in case of banking company, and the messages are sent through a system called as SWIFT. Now, in case of SWIFT, very important is please understand sometimes you will loosely understand, or loosely people would say that they have received funds through SWIFT. So actually, SWIFT does not carry any funds. SWIFT is only a messaging type for instructions to be passed on from one bank to another, messaging to be done between two financial intermediaries, basically. And in case of banking companies, in case of you are auditing any banking company, this has created a lot of issues for bankers as well as the auditors also. Very recently, if you remember, there was a case of PNB where there was a huge fraud which happened in case of area called as buyer's credit. We'll understand what is a buyer's credit also. So in case of buyer's credit, there was a huge fraud which happened. A person named as Nirav Modi, nobody can actually forget that name now, where they claim that a lot of SWIFT messages were sent without the knowledge of the senior people and without making any entries in the books of account, which created liability for the bank basically, and which the bank was not even aware of. So how could that happen was because SWIFT is a authenticated message type. So once a message is sent through SWIFT, whether an entry is done in the books of account or not, it would create some kind of a liability or an asset for the bank. So then, of course, there was a hue and cry as to how this missed the audit system also, and RBI realized that it was possible for the custodians in the bank to actually send messages without necessarily making an entry in the books of account of the bank. So in case you are auditor to a banking company, this becomes a very, very critical element where you have to actually check what is the internal audit mechanism in the bank to verify that wherever a SWIFT message has been sent, appropriate entries has been done in the books of account of the company. So this is one area where every bank has then taken certain steps, including linking the SWIFT system with the basically the accounting system to ensure that wherever a SWIFT message is sent, there is a corresponding entry in the books of account of the banking system also. So as an auditor to a banking company, this has become as a very high risk zone, and you need to verify the internal audit process and how effectively it is working to ensure that the all the entries are actually made in the system. These are one or two cases which I remember of frauds being committed through SWIFT messages. In case of Indian Overseas Bank, there was a fraud which got committed of around 300 crore rupees, wherein one of their managers in a forex branch actually created a company outside India and transferred the money from the Nostro account of the bank in 16 different installments through SWIFT messaging, and then he resigned the left and left the bank before the fraud could be detected. So again, misuse of SWIFT system and the non-reconciliation of that Nostro account of the bank led to this loss kind of a situation. PNB, we have already discussed the fraud, and we'll understand what is a bias credit transaction to understand its implication as an auditor to any organization. And then we had a fraud in Bangladesh, which was nearly amounting to 1.01 billion US dollars. Again, where the SWIFT system was somehow hacked for the purpose of doing this fraud. And though not very relevant for us from the organization other than a banking company, but from a banking company point of view, very risky, basically. So as an auditor to a bank. Incoterms would be very important. So we have heard the concept ki FOB and what is CFR or CIF. We have heard those concepts. They are collectively known as Incoterms or international commercial terms. So as an auditor, which is doing a audit for any of the forex transaction, we should be actually aware of the Incoterms, the relevant concept of Incoterms, in case the Incoterms changes from say EXW to FOB or FCA or FAS or CFR or CIF, what is changing? What is the liability? What is the obligation of the Indian party in such a transaction? So you need to be very aware of it. Of course, if you are looking at the definition, where you can see the exact definition, because if you look at Google, you will find 100 versions of each item. So look at different websites, you will find different versions of the same Incoterm. So the authentication comes from Incoterms 2020 is the latest version of Incoterms. Earlier it was Incoterms 2010 given by ICC, International Chamber of Commerce, as we discussed earlier. So you should be aware of the Incoterms and the change in the liability or the obligation of the Indian party in case there is a change in the Incoterm. Okay. Then, okay. So in case of imports, basically there can be imports. You can any company can do imports into four methods. One is what we call as a direct import transaction, wherein they first get the goods, and then there is a shipment of goods from the supplier, and then they go to the bank and ask for the payment to be done. So this is called as a direct import transaction. Then we have advance import. In case of advance import, the Indian buyer would be first making the payment outside India as an advance, and then only he will be receiving the goods. So there is a limit also because there is an inherent risk in making an advance payment outside India. So RBI has also imposed certain restriction into terms of how much advance payment can be done. So the general limit provide for a limit of USD 2 lakh for goods and USD 5 lakh for services. And the bank have been given power to allow a transaction in case certain parameters are met and banks takes a call, they can do up to a 5 million transaction. Otherwise, it requires a bank guarantee or a standby letter of credit from an international bank to cover the risk of non-receipt of goods or non-receipt of refund of this amount which has been given in advance. So in case your company has given advance, please look at these guidelines and check whether any breach of limit has been noticed, which is a very important guidelines. Then in terms of imports, you can also do it through collection, bill for collection we say, or through under LC, which is actually one of the preferred medium because it gives you a coverage in terms of bank giving you a guarantee that they would make the payment of the goods in case the goods have been sent or the goods have been received as per the terms of the trade. Okay, so this is there. In case you have given a payment for import within 6 months, you should be receiving the goods. In case you are not able to receive, or in case there is a delay in making the payments of the goods, then of course you will have to seek an extension of time from your authorizer. So in case of an audit, please look at all the cases where you have received the goods, the party has received the good, payment has not been done within the specified timelines of 6 months, and whether the steps have been taken by the organization in going for an extension of timelines with the authorized dealers. So this is important. Then in case of import, the most important fact and most important document which we used to say was the bill of entry, which was issued by the custom authorities on receipt of the goods. So it used to be filed by the importer, and based upon their verification, they used to give 2 copies to the importer. One copy, which we used to call as the exchange control copy, was to be submitted to the bank, and the fourth copy was for the records of the importer. Then the system got modified in 2017. The system got changed to an online system which is called as IDPMS, Import Data Processing and Monitoring System. So we should be aware of the intricacies of this system, how this system actually operates. Because this is, when we look at an audit, we always seek for some external confirmations. So SA 505 talks about external confirmation, the importance of having external confirmation, and how much the auditor can rely upon an external confirmation. So IDPMS system provides us some kind of a confirmation relation to certain transaction when it comes to an importer actually. So you should be aware of it. One of the audit evidence we always call in case our client is an importer is the report of the IDPMS system. Of course, the importer does not have the access directly to the IDPMS system, so we generally call for that information from the banker of that uh, uh, organization. They can provide us the report on the IDPMS system, and this helps us in verifying a lot of transactions from the IDPMS system. We can re-verify the transaction which has been recorded in the books of account. We can also verify cases where, say, there has been a payment for in advance for the import, and the money has the import has not been done, and there are other cases where the import evidence has not been filed. All these get reported under the IDPMS system. So in case you are auditing a importer, please ensure to obtain this IDPMS report and keep the copy of that in your audit file for future reference also. And it gives you basically a clear evidence that you have actually done your due diligence in regard to the forex transaction, in regard to the importer, what forex transaction they have performed and what kind of issues may be pending there. So you can actually look at this. Okay. Then of course we have a concept of bias credit. I'll just take 5-10 minutes of your time on understanding bias credit. Again, this is one area where I have seen a lot of issues. So one of the issues which I have seen is that a lot of times what happens is a bias credit transaction. The importer has done a bias credit transaction, but they have not done the recording of that bias credit in their books of account. So you will say how it is possible that somebody might have done a financing transaction, but they may have not have recorded that in the books of account. So we'll understand how this modus operandi actually works, and then you will be able to understand that it is sometimes if they are not able to understand or deliberately hides the information, the client, you may not be aware that your client may have done a bias credit transaction. So how a bias credit actually works here, just a flow chart for your understanding. So there's an X who is a buyer, he's an importer. There is a seller buy bank where payment has to be done for a transaction. Then we have a JP Morgan bank, which we are assuming is the credit extending bank. Now, in most of the cases, let me also tell you that what we are seeing is that because there has been a change in the interest rate scenario across the globe, there has been increase in the interest rate across the globe. what we have seen, a lot of buyer's credit transactions are not being done through foreign banks now. It has been done through uh, foreign branches of Indian banks, or banks have opened branches in Gift City. So you must have heard of Gift City, which has been opened in Gujarat. And this the advantage of Gift City is that any branch opened by a banking institution there is considered for the purpose of FEMA as a foreign country, basically. So any transaction you do with Gift City is basically like as if you are dealing with a foreign country. So a lot of foreign exchange transaction of buyer's credit are actually being done through the gift city. Does not change the concept remains the same. Okay. And Bank of India Noida branch we have assumed is the banker for X in India. So how this transaction actually works is basically buyer's credit is financing of an import transaction. It can be done by either a foreign bank or overseas branch of an Indian bank. So local branch cannot give you buyer's credit. Okay. So X approaches for credit facility loan for import. He has to make a payment to the seller via bank. JP Morgan basically what it does it gives them an offer letter. It asks for a LOC or LUT. This has changed. This LOC LUT has now been replaced with bank guarantees. We'll understand it in the next slide. So earlier it was a concept of LOC LUT. Why I have retained the word LOC LUT here is to make you understand how that transaction happened in case of that PNB where that fraud actually happened, right? So LOC LUT in case is demanded. LOC LUT is kind of a guarantee which the bank used to give. So X cannot give you that LOC LUT. So you'll have to approach Bank of India for issuance of LUT in favor of JP Morgan. So when Bank of India actually issues a LUT in favor of JP Morgan, it undertakes a liability upon them to make the payment on the due date of the principal amount plus the interest, irrespective of the fact whether X makes the payment to Bank of India. So, Bank of India ideally would not issue a LUT unless until we have obtained sufficient security from X for issuing this LUT. And this was the issue with PNB. That PNB has been issuing LUTs in favor of mostly it was foreign branches of Indian banks only, and they did not have any security. Rather, they did not make any entries in the books of account also, which was claimed to be on account of certain person doing these LUTs. So LUTs were being sent through a Swift message called as 799. MT799 was a Swift code. So they were being sent, which was creating liability for PNB, which the PNB claims they were unaware. Okay. So this was the whole transaction. Now, what happens in case of this LUT being provided? JP Morgan either makes payment directly to the seller via bank or credits the nostro account of the Bank of India in our example. And on the basis of the credit entry received in the nostro account, Bank of India would make payment to the seller by bank. Now here what has happened is the loan has been taken by X, the buyer, right? But there is no entry in the books of account of X. So in case they do not make an entry in their books itself, you would not be even aware of it, that a buyer's credit transaction has actually occurred. Because what has happened here is the liability of the seller Y has been taken care of. He has been repaid. Now, in place of that liability, a certain creditor, there is a short-term loan which has been obtained. And of course, there would be an interest element also in that loan. There would be a uh, issue as to the disclosure of that in the appropriately in the financial statement. But we have seen cases where what the party has done, the organization has done, they have not recorded this entry in the books of account. They continue to show seller Y as a creditor in their books, and seller Y actually, when they actually repays this loan, they actually they consider it as a transaction where they are making payment to seller. So this is not something which is proper. We need to be careful about any such transaction. Okay. Okay, there's also a supplier's credit. We'll just skip it for now. This is maybe more important for an auditor who are banking company. Okay, so what is important here is that you should be aware of a buyer's credit transaction, how it is operating, and there would be an interest element in it. And of course, if there is an interest element, please also be careful about withholding tax for interest payment, right? So somebody might have an thinking that in case the interest payment is happening to a bank, then the withholding tax may not be required. But of course, if it is to a foreign bank, or even sometimes when I actually talk about it, even if a loan has been obtained from a branch of a foreign bank in India, like in case of maybe Citibank or Standard Chartered Bank, then also withholding tax may be applicable, which we need to be more careful. Okay, so this the practice of LOC LUT, of course, as I told you, was discontinued after the PNB fraud, and then in place of it, there was a concept of basically bank guarantees, which came in place of LOC and LUT. So the buyer's credit transactions are still happening, but of course, the concept of LOC LUT has been replaced with buyer's credit. Okay, so this is very critical. This is one of the transaction where you will see a lot of transactions being done by Indian importers in buyer's credit. Please verify. One, of course, is whether that has been properly recorded in the books of account. And secondly, in case there is a payment for any interest, there might be a case that that interest may be have been not accounted for as interest on buyer's credit. They may have been put in the bank charges by the your customer, because ultimately it is debited by the bank only, and payment is remitted to the foreign bank or the overseas branch of that bank. So they may be accounting it as a bank charges and not deducting TDS or withholding tax over it, which may be a serious issue for you as an auditor to our organization. Please be careful and ensure to verify whether there is a bias. One is, of course, we look at whether there is a bias credit limit for that company. Then we try and take an external confirmation from the bank as to how many bias credit transactions have been allowed during the year and what are the outstanding of bias credit at the end of the year, which would actually help you in doing a proper audit. Okay. Then 15 CACV becomes very critical. It is basically for wherever you're doing a clean output remittance, please ensure to verify 15 CACV. They may have been taken from you, they may have been taken from some third party. We are seeing cases where a lot of organization, what they are doing is that 15 CA basically has four parts. So 15 CA part, the four parts are part A, part B, part C, part D. We'll cover it a little later also. We'll touch upon it. A lot of times what we are seeing is part D is basically being required to be issued when the amount being remitted is not chargeable to tax in India. So you are making a payment to a external to a for non-resident, and that amount is not chargeable to tax in India. So in that case, 15 CV itself is not required. 15 CA part D is being issued by the Indian remitter. But sometimes we are seeing cases that 15 CA part D is being filed and the remittance has been done by the banks. But there are cases where it still requires a deduction of tax at source or withholding tax basically. And through this, when we do not verify, we think that the bank has allowed a transaction, but bank has allowed a transaction based upon a declaration filed by the company. So we need to be careful about any such transaction and need to verify it. We'll discuss it a little later when we talk about withholding tax also. Then similarly, in case of exports, export the like we have IDPMS system in case of imports, we have EDPMS system in case of exports. So export data processing and monitoring system, right? So similarly, when we do an audit of persons where there is a export elements they are doing into exports, we try and obtain this report of EDPMS from the bank and use it for the purpose of verifying our audit process. It would contain details of exports done where the realization has not happened, where advance payment has been received, but the export has not been done. So this becomes critical. Then, of course, what is the manner of export realization? We can, as I told you, if you look at the third entry, clause C, it says payment out of fund held in FCRA NRE account of the buyer. So as I told you, it is an eligible way of receiving funds from the buyer. In case they maintain an FCNR or NRE account in India, then also it is permissible that they make a payment through FCR NRE account, and it will be considered as a permissible way under the FEMA guidelines for receiving foreign exchange. So this is important for us to understand. Then the time limit for export realization, it is 9 months. except in case where we are exporting to our own warehouse established abroad, wherein the maximum period is 15 months. Okay, so this is again why it is so important is to understand that in case there are cases which you can see from the EDPMS report where the realization period has expired, then we need to see whether the client has actually gone to the bank for enhancement of the limit, extension of the period for the export done by them. So this becomes important for us to verify because it would have some kind of consequences under FEMA. So we need to verify whether the compliance has been done. And as I told you about SA 250, which requires us to verify the compliances of all laws. So there it becomes important for us to verify, and maybe if required, if you feel as adequately comment upon it in our audit. Okay, then write-off is something which is also permitted. So bad debts can happen in the local trade also, and in case of exports also. So there are specific regulation in terms of bad debts and how they can be written off and how much limit is there. So you need to verify. Just writing off in the books of account, sometimes what we have seen is the clients write off their books of account without actually going through the write-off process. So these entry again you will be able to verify through EDPMS system, and you need to verify that the client has actually followed these guidelines before they actually allow a write-off of these export proceeds. Okay. Then third-party payment. So this again is a very critical area, and it is AML risk which we carry. This is applicable both to a banking company auditor as well as a company auditor otherwise. So say suppose your company has exported goods to Mr. A and the payment is been realized from Mr. B, and they want to say this is a payment received against export done to Mr. A. And on the flip side, they have say done an import from Mr. A and they are making payment to Mr. B and they are saying this is against import done to Mr. A. So this is called as a third party payment for export import. There are very specific guidelines as to in what circumstances the same may be allowed, right? So you need to verify in sample cases whether the payment is being done to the same party from which the import has been done, or payment has been realized from the same party from which export has been to which export has been done. That you can verify actually through the there are payment realization receipts which the banks issues to the customer. So you can actually verify that. In case it is being received from a third party or being paid to a third party, you need to verify the compliance of these guidelines, because in case these guidelines are not met, which are very specific, in that case the only way this is permitted is through the specific approval of the Reserve Bank. So this becomes a very critical activity as far as money laundering is concerned. And we have seen cases where auditors were asked to answer on these issues, and they suddenly found out that a lot of these transactions were done by their client, which they either did not verify or were not even aware of. Okay. Then there is a concept of a merchanting trade transaction. What is a merchant trade transaction is basically like we have a concept of bill to ship to kind of a situation here. So say X in India is importing goods from Y from US, and they are actually sending these goods directly to Z Australia. Okay. This is called as a merchanting trade transaction. So here there is an import element also from Y to X, and there is an export element also from X to Z. But actually the goods do not arrive in India. So this is again an area which is fraught with risk, because there would not be a BOE in case of import transaction. There would not be a shipping bill in case of export transaction, and it may be only document which has been created. So this is for RBI a very risky area as far as money laundering is concerned. Formulated certain guidelines which are in addition to the guidelines of export and import, and which we need to verify that in case your client is into merchanting trade transaction, this is called as merchant trade transaction or intermediary trades. We need to verify that whether these guidelines have been properly followed or not. In case it is not so followed, RBI is actually very strict about these guidelines, and there might be consequences for the client which you need to bring out to your audit. Okay. Then we have we have concept of shipping finance, pre-shipment finance, and post-shipment finance. What we have seen is we understand what is a pre-shipment finance in terms of export packing credit, etc. What we have seen is we have seen cases. I remember one of the cases where we have to actually report that finance was taken for basically export packing credit, and it was used for purchase of factory building by the organization. So again, a misuse of it. Then you may have to actually report it through your CARA report in case it is a company. And then, of course, even our CARA report now covers an area wherein the client also has to incorporate that in their notes to account, and you also have to report upon it, whether the statements being quarterly statement being submitted to the banks are in agreement with the books of account. So the area of EPC and PCFC again becomes important. Please look at especially the end use of funds, because in case of EPC, the funds are disbursed based upon an export order. So what we have seen is cases where there has been a misuse of funds received for export packing credit into other areas, which is specifically not allowed. So you may have to specifically report or cover it in your audit report. Then post shipment is there. LCs will not specifically cover LC, but you need to verify these transactions also. Now coming to the capital account transactions. So we'll basically touch upon three areas. One is what we call as a foreign direct investment, FDI. Second is what we call as overseas direct investments, ODI. And third is what we call as an external commercial borrowings, or ECB. These are the three most important capital account transactions which are there. I'll touch upon briefly on each of them and understand what are the important areas to be taken care of here. So what is FDI? Is investment by a non-resident. It may be a company, it may be individual, in an unlisted Indian company, or in 10% or more of the post-issue paid-up equity capital on a fully diluted basis of a listed Indian company. You can have an investment into LLP also, which would mean capital contribution or acquisition, transfer, or profit share. And we have very important concept of a downstream investment. We'll touch upon it. What is downstream? We are recently also handling a case where a company was under acquisition, and under the due diligence process, it was pointed out that they have violated the FDI guidelines, basically the downstream investment guidelines. So we'll understand what is a downstream and why it is so important for us to understand it. So, okay. So what is a downstream investment? We understand FDI. We are not going to go into detail of it. So downstream investment is, say there is an entity X in India, which is say a private limited company or a limited company. It has investment from A Limited, which is a US company. Now X Limited say acquires another company or forms another company under it, say Y Limited. Now investment in Y is not made by that any entity from outside India. It is only owned by X Limited, say. Then also, Y Limited may be considered as having indirect foreign investment. Why? Because the investment made by X, they have foreign direct investment. So it is basically that they have an indirect foreign investment. This concept sometimes we are not either aware of, or sometimes we just miss to verify this area, because it requires a lot of compliances to be done, including filings to the Reserve Bank. So as you can see in the example, non-resident Indian, then we have an Indian company at first level, owned and controlled by a resident. Okay, then Indian company second level, not downstream investment. So basically what they're saying is that the Indian company at the first level, it should be either owned or controlled by non-residents. Either owned or controlled, any of one condition is satisfied, then any investment it makes further in a second level company, it would be considered as an indirect foreign direct investment. And you have to comply with certain regulation, including filing of the downstream investment form to the Reserve Bank of India. And every year also you have to do a compliance of these guidelines. There is a specific reporting also which has to be done in the annual report by the company of such downstream investment. So sometimes we miss out to verify such issues, and later on there are problems in terms of penalties being levied or compounding fees. We need to go to the Reserve Bank of India for requesting them to compound the offenses of not reporting the payments. So these are very important. This is again how this actually works. Then this is the form which has to be filed. So for form DI has to be filed for reporting on downstream events. Okay. This is spreads note 3, which came in during the times of COVID. Basically, it stated that any entity of a country which shares land border with India, or where the beneficial owner of such of an investment into India is situated in or is a citizen of any such country, can invest only under the government. So basically, people were saying, and of course, China was the major country which got impacted by this amendment. So this is very important because what we have seen is it is not only talking about companies which are situated in China or citizens of China. It say they may have opened an entity in some third country, say in Singapore or in some other country, and that country may have the FDI has come from the third country for investment into India. Then also it is hit by that guidelines. If the beneficial owner is basically situated in any of such countries. So in any case where you are handling any such case or your entity has received foreign direct investment, please check the beneficial ownership of those entities which has invested into your entity, because it may be a prohibited transaction which you may be handling and may not report. Then we have a concept of a liaison office, branch office. So this is where investment is made not by investing into any company in India. It is made by opening a branch office or a liaison office in India. So in case you are handling any such entity which has opened a branch office or a liaison office in India, so you need to verify in one the activities which are permitted. So in case of liaison office, these are the permitted activities. In case of branch office, these are the permitted activities. And then you have to verify there is an annual activity certificate which has to be issued, which has to be filed. There is a compliance in terms of ROC guidelines which has to be done. There is a compliance in terms of any foreigner which is there in India. So there is a compliance of those guidelines also in terms of FRRO guidelines. That also needs to be verified by you whether these guidelines have been met. Okay, then investment by residents abroad. Similarly, this is Indian investors investing abroad. In these cases, acquisition of unlisted equity capital, subscription as part of the memorandum and articles of association of a foreign entity, investment to 10% or more of the paid up equity capital of a listed foreign entity, investment with control where investment is less than 10% of the paid up capital of a listed foreign entity. So these are ODI guidelines. Now, in case of ODI, you have to verify one, wherever the investment is to be done. The first time when the investment happens, would be a there would be a UIN number, unique identification number for that investment. You need to verify that the UN number has been generated before the investment has been done. Second investment cannot be done unless the UN number has been generated for the first investment. You need to verify that APR, annual performance report, is submitted every year by 31st December. For this year, there was a lot of hue and cry about APRs. I have received numerous issues, requests from other professionals regarding APRs, where because there was certain change in guidelines which happened, and this year it was mandatory, except in certain cases that the APRs, APR is basically for the performance of the foreign entity where you have invested. So there was the banks asking everybody that in case your foreign entity is audited, then there is no issue. In case it is not audited, then also it is mandatory for you to get them audited. So there was a lot of hue and cry as to the fact that in certain countries, the audit may not be mandatory or may not be mandatory for certain level of companies. But then also it was the banks were forcing or asking the customers to actually submit audited accounts of these foreign entities. So it was due to change certain guidelines, which you should be aware of. And then one report which goes every year for any entity which has received foreign investment or which has made any overseas direct investment is foreign liabilities and asset report, which is called as FLA. It is to be submitted by 15th June every year, 15 July every year, and it is filed now directly through RBI to RBI through the FLAIR portal. Now, I have seen cases where people are not aware that the FLA return has to be filed, and later on they are now being asked to pay late submission fees for the same. And now, even in case you have not filed your FLA return, in case you go for a ODI investment, the bank would not allow you to do ODI investment. So please ensure that your client is filing this FLA return, which is a mandatory return under the guidelines. And generally, the fact is that all these reports actually is filed through the bank, but FLA return is one of those reports which is filed directly to the Reserve Bank of India, and that is why the banks do not follow up in case you are not submitting the return, but and the customer miss out to file those return, which is a mandatory guide. One again an area which we saw, which is specifically change in the guidelines, is wherein what has happened is that in case you have given a loan to your foreign entity, then you need to charge interest on arm's length basis. This was there earlier also, but now in the revised guidelines which has come, it has been specifically stated therein that interest needs to be charged on arm's length basis. Of course, this was earlier a requirement also under the TPA guidelines, the transfer pricing guidelines under the Income Tax Act. But sometimes we have seen people not charging interest or not specifically mentioning any interest, which needs to be done now. Then in investment case of cash infusion. So a lot of times what we have seen is people coming to us telling us that they have done investment in a foreign entity. They have gone for a visit there. They have paid certain amount in cash they were carrying for that travel as an investment in that entity, which is specifically not allowed. So in case your client comes out with such a request, please ensure to check whether the same is permitted, which is not under the current guidelines, and ensure to take appropriate action and in your audit. That direct investment in step down subsidies. So what we have seen also sometimes is people, so they have, say, an Indian entity I has an investment in Singapore, S Limited. Now that S Limited has a further step down subsidy. So, as per the regulations, you are not allowed to directly invest into the step down subsidiary. The money has to be routed through your the first level subsidiary only. Guarantees, etc., can now be given, but otherwise the money can flow only through the first subsidiary. So we have seen cases where the direct investment has been made in the step down subsidiary, which you need to verify. In case such relation exists, then of course you need to appropriately carry it out through your country. Then external commercial borrowings, there is a form ECB which needs to be filed, and a monthly form ECB2 again which needs to be done. One of the major area of concern is that we have seen cases where money has been received at external commercial borrowings without obtaining the LRN number. So first you have to apply to RBI in case you are looking at taking some ECB, external commercial borrowing, and obtain a loan registration number. Without obtaining a loan registration number, you cannot draw down under the ECB. What we have seen is that, say, there is a foreign entity which is having a subsidiary in India, and they sent certain money in India as loan, but they misdeclared or inadvertently declared something else while filing it to the bankers, and the money was booked under loans in the books of account, but the necessary the follow of the regulation was not, and the money later on, due to some issue, it was pointed out that it is a violation of the FEMA guidelines. So please be careful where the money is being received from non-residents or foreign companies as loans, that the compliance of the ECB guidelines is being done. Okay. Then accounting standards, AS11, similar we have indexed to AS21 related with the AS39. So basically we are all aware of it. It talks about basically that whatever difference monetary items, and it talks about monetary items and non-monetary items. So AS11 is applicable to exchange difference on whatever difference in foreign currency is there. we need to book it as a profit or loss. And in case of the biggest issue, what I've seen in the AS level where there is a lack of compliance is that wherever there is a change in the foreign currency, say you booked at an X rate, the transaction actually happened on a Y rate. So that actually gets booked into the foreign exchange difference account and it gets appropriately covered in the audit also. But their AS level is also applicable to foreign exchange differences arising on the forward exchange contracts. Now, these contracts may not be visible in the books of account. There may not be any specific entry which your enterprise may have done on the forward exchange contracts per se, but any foreign exchange difference which may arise on that account also needs to be appropriately booked in the books of account. So here again, it becomes important for us to basically take a confirmation from our enterprise for which we are doing the audit, and from the bank also as to how many forward exchange covers are open for that client, and to appropriately take any difference in the books of account in the each balance sheet date. Okay, and the value of contract is marked to market, and the gain or loss on the contract is recognized or amortized depending upon for what purpose it was taken as expense on income over the life of the. Okay, then we have section 43A and 43AA of the Income Tax Act, and this 43A is basically in relation to forward exchange differences in case this is in relation to purchase of a capital asset or any money borrowed, including interest for the purchase of that capital asset. So basically, we are all aware of that it should be added to the cost of the capital or the capital expenditure as per the relevant provisions. And 43AA refers to ICDS, another set of accounting standard which we need to deal with. And it basically is quite similar to what we see in case of the accounting standards 11 and Ind AS 40. Okay. Then we have transfer pricing regulations. So we have section 92 to 92F of the Income Tax Act, which 192A defines what is an associated entities and type of transaction which are specifically covered in section 92B. So it talks about sale, purchase, or lease of tangible or intangible properties, provision of services, cost sharing arrangement, lending, borrowing of money, which we specifically talked about also, or any other transaction having a bearing on the profit, income, losses, or assets of such enterprise. And specifically, as an explanation, they have added intangible properties, provision for guarantees, deferred payment or receivables, business restructuring or reorganization, etc. So here again, guarantees, which is an essential part of overseas direct investment. A lot of times the companies give guarantees on behalf of these for their foreign entities. It may get covered into the transfer pricing regulation, which we may actually skip out. Then this is a very important amendment which came to my mind. I thought of sharing with you. There is an explanation 2A inserted in section 9(1) of the Income Tax Act 1961, effective from financial year 21-20, for very recent tourism. It has a very, very wide-ranging implication for us. It talks about a concept called as significant economic presence, and it says that significant economic presence shall constitute business connection, non-resident with transaction of goods, services, or property, including provision or download of data or software in India to any person in India for a value of more than 2 crore in a financial year, deemed to be a business connection. And this is irrespective of the fact whether the agreement is in India or abroad. Non-resident has a place of resident or place of businesses in India. So basically, the impact of this is that in case this non-residence has a significant economic presence in India, it would constitute a business connection. And for constituting that significant economic presence, the criteria is that they are supplying goods or services of more than 2 crore in a financial year. It may be to a single person, it may be to a multiple person. Now, in case this person is covered by this significant economic presence, the problem would be some profit would be attributable to the above activities will be deemed to accrue or arise in India and may require a withholding tax under section 195. So this is a very, very critical point, that wherever you have a client who is importing goods or services into India and dealing with a person who may be transferring goods or services more than 2 crore in a financial year, that transaction, even of import of good, may require a withholding tax. So please go through this amendment which has happened, and please be guided as to what steps needs to be taken as far as your audit report goes. Then we have a concept of withholding tax, 15 CACP, which we all are aware of. Then we have concept of equalization levy. This is again a very important area. Earlier, it was basically applicable to online advertisement, provision for digital advertising space. So making, say, payment, you must have seen clients making payment to Google, making payments to other entities for the purpose of giving those ads on those websites and everything. So that is covered by the equalization levy. Recently, e-commerce also has been incorporated into it with effect for April 1, 2020. Please be very careful about it, because in case you do not do a withholding tax, even equalization is actually covered within it. The disallowance of the whole expenditure, it may be even purchases, that may be the result of it under section 40 small a. So please be very careful about this, the concept of the equalization. Then the reverse charge under GST, it is applicable where you import a service, whether in course of the furtherance of business or import a service, especially this is the critical area, without consideration by a taxable person from related person or from any of his establishment outside India. So he may not have charged for it, but because there is a actual provision of service, it may still be required to be taxed under reverse charge under GST. So here the provision of corporate guarantee to foreign subsidiaries, temporary transfer or permitting the use or enjoyment of intellectual property rights constitute supply of service. So these are some of the elements which may be very, very critical and need to be considered by an auditor while looking at these foreign exchange transactions in case of an entity in India. Then LEI has been made mandatory for transaction of 50 crores and more undertaking after 1st October 2020. We should be aware of it. Then, of course, external confirmation, as we talked about. So EDPMS, IDPMS, I talked about, very important. Then in case your client is basically into trading transactions, imports, exports, please obtain this report. Bank certificate for balance confirmation, bank certificate for buyer suppliers credit, bank certificate outstanding forward covers derivative contracts. As I told, it is important specifically in relation to AS11 and providing for any foreign exchange difference. Confirmation for any BGs invoked, LC devolved, which your client may not be telling you. Then confirmation on any of their reports. Then your audit reports. This is very important. How do you appropriate it? Because ultimately the crux of all the working which any auditor would do is basically to generate an audit report which would effectively communicate what is his findings ultimately to the audit. So assessing the audit evidence with appropriate evidence, arriving at an audit conclusion based upon management responses, drafting an audit report, finalization, and of course the UTIN generation. This is the most important. So I have tried within the limited time to cover the complete area. Of course, I know I have been basically rushing into a lot of things. The idea was to basically bring out the elements involved into a audit of a forex transaction, bring it to the table. Of course, we have all these professionals, brothers here and sisters here, who are basically well equipped, that once they understand that there may be an issue, they can actually go into detail, understand the issue. So the idea was to bring the elements into a forex transaction, forex audit into onto your table. Now I open it for any questions, answer which you may have on this. Thank you so much for your patient hearing.
Yes, sir. Thank you, sir. Thank you so much, sir. Thank you so much for detailed and wonderful deliberation. You have covered almost all the aspects relating to this forex transactions. So now we have received certain questions. May I request Shri KK Jain ji to please start the proceedings of QA session, sir. Over to KK Jain, sir, please.
Thank you, sir. Sir, first question I received is, may I read it, sir? Now,
जी
sir.
when resident wants to transfer listed company shares to relative non-resident, prior approval of RBI is required or not? And what is the limit of transfer of demat shares in total value consideration and applicable regulation?
So, sir, I think the question actually needs further details because, as I told you, that in case you are making an investment into a listed company, actually there are two regulations. The regulations are covered under foreign direct investment, but under foreign direct investment, either it can amount to a direct foreign direct investment or it can amount to what we call as a portfolio investment. So depending upon the case, whether it is a case of a portfolio investment or it is a case of foreign direct investment, the person can be guided as to what are the requirements. So in case it is a foreign direct investment, then the gift is permissible, but a filing needs to be done, which is called as FCTRS, to the non-resident. The permissibility of gift also needs to be also verified in terms of the sector in which the company is operating. So there are certain sectors where foreign investment itself is not allowed. So in case you want to transfer the shares to a foreign resident, then in that case it may not be permitted on the FD guidance. So we'll have to test it in terms of a lot of elements which needs to be obtained, and then only it can be decided. If it is less than 10% of the equity of the listed entity, then it amounts to a portfolio investment and it is much simpler. But of course, still a certain regulation needs to be verified before we can give a final answer.
Thank you, sir. The second question is, sir, there are EEFC bank accounts in two different banks. Transferring USD/Euro from one EEFC account to another EEFC account of same company, AD to AD transfer. Is this fall under capital account transaction or current account transaction? Sender and beneficiary in this case is the same. Is there any specific approval required in such circumstances, in such remittances, sir?
So, sir, to my mind, what I understand is one, as I told you, the definition of capital account transaction is where there is a change in the asset and liability or contingent liability outside India of a person resident in India. So when you talk about EFC account, I'm assuming he is a person resident in India, and his asset and liability outside India is not changing. It is within India, it is changing. So as far as the concept of current or capital is concerned, it is really not applicable here because it is a transition within India only, right? Secondly, whether the bank would allow a transfer between EFC accounts maintained with two different banks. Generally, bank would be much more reluctant in doing it because of that regulation which I specifically told you, that whatever credits we have received in one calendar month needs to be either utilized by the end of the next calendar months or needs to be converted into your normal current account balance. So in case they allow a transfer to happen like this, it would be very difficult for any bank to verify what are the credits in each calendar month. Because say at the end of, say I received a credit in December, I transfer that money to some other EFC account maintained with some other bank at the end of January, say on 30th January I transfer, then bank would only have received credit on 30th January. So it will have to allow another 1 month for the transaction to get complete. So actually it may result into violation of the FEMA guidelines. So bank will be very, very reluctant in actually allowing such a transaction.
One more question, sir. Can a Bangladesh incorporated private limited company acquire 25% stake in an Indian private company without approval?
No, sir, because we talked about a specific press note of 2022, which talks about any investment from a country sharing land border with India requiring approval of the government before this investment can be done. So any investment done by this Bangladesh entity would require a specific approval from the government of India, not only RBI, sir. It is approval from government of India actually. So there is a specific process which has been prescribed for it, and this investment would have to first go through that process. Once the approval is received, then only that actual investment can be done, without which the investment is not allowed.
Okay, sir. The next question, sir. A lady who expected to die shortly transferred her funds to her daughter in ordinary accounts, who is an American citizen and non-resident in India. Now, the daughter wants to transfer this fund to her American account. Can she do so, sir, under LRS or other scheme of non-resident?
So, sir, LRS in this case would not be applicable because, as I told you, the specific condition of LRS is that it is applicable only to a resident individual. And I am assuming that daughter, being a US citizen, generally would not be a resident. They can be a resident because there is no condition of being an Indian citizen for residential status. But as the question is worded, I understand that the daughter is not an Indian resident.
Yeah.
So the LRS scheme is not applicable in such a scenario. Now, the second fact that the money got transferred, so the money would go to the NRO account of this daughter. It would be deemed to be a gift because the intention is to give it as a gift. The money get transferred outside India as under a scheme wherein you allow a remittance from an NRO account up to USD 1 million per 1 million USD per year, per financial year, you allow after payment of due taxes in India. So to that extent, it may happen, sir.
Yes.
But that is subject to the due diligence being carried out by the bank. And they would require a Form 15 CB also, 15 CACB also from where a CA would be required to certify that there is no tax liability on the amount transferred outside India.
It is in case of gifts, sir, and this 15C or series also to be issued or to be.
No, sir, the amount,
in case of
it is not due to
related-
gift, sir. It is wherever the amount is being remitted outside India from a NRO account.
Okay.
Would require a certificate from a CA as to the due payment of tax on that amount being transferred outside.
Right, sir. Right.
So that is the requirement.
Next question, sir. Suppose SSC who has become now resident, but when he was NRI, he has account in another country in which salary credited, which is still parked in other country's bank account for last many years. What disclosure required as per FEMA, sir?
So there is no requirement of any disclosure under FEMA, and they can continue to hold that asset in that foreign country without being forced to bring that money to me. So that is very clearly stated. Of course, once he become a resident under Income Tax Act, there may be a requirement of disclosure of that foreign bank account in his income tax return to avoid the application of the Black Money Act. So that he needs to be careful about.
Okay, sir. Next question, sir. What is the advantage of dealing in FC transactions oblique borrowings from banks in gift city rather than dealing with foreign banks directly in their country of origin?
So there is no specific advantage. See, it is depending upon the case to case. So certain times what happens is that earlier what was the scenario was, if I practically talk about, was that the interest rate scenario in foreign countries was quite on a low scale. So if I talk about 6 months LIBOR in case of Euro was practically running into negative territory for many years. Now the scenario is such that the interest rate has run up in nearly all the countries. So in most of the cases, what is happening is, considering the complete cost, it is generally not feasible for you to obtain loans from a foreign country now, unless until they are giving you certain advantages. So say suppose you are importing machinery from say Germany. So in certain cases, the German bank, as a measure of encouragement towards that import from export from Germany, would allow you to get credit at a very low rate of interest. So in those cases, it would make sense to get credit from them. Otherwise, now Gift City being an entity which has been formed in India for the purpose of facilitating these transactions and making India a financial hub for all these transactions. In a lot of cases, it makes equally good sense to maybe take a loan from Gift City, facilitated through Gift City, or maybe getting it outside it. So it will depend upon case to case. There is no specific advantage or disadvantage in terms of these
Next
transactions.
question, sir. Sir, what are the key considerations to verify the payment or utilization out of export proceeds maintained overseas?
You are maintaining a foreign bank account outside India and receiving export proceeds therein. Is it the required question, sir?
Payments or utilization out of export proceeds maintained overseas, sir.
So one, sir, you cannot maintain a foreign account in a foreign country for receiving export proceeds without getting a specific approval from the Reserve Bank of India. So
Okay,
it
sir.
requires a specific approval. And once you get an approval, the approval itself would say what are the. So generally, they would not allow you to utilize that sum there. It would be only for the purpose of collection and then remitting the sum to India.
Okay.
But of course, you may apply specifically to Reserve Bank of India, citing the exact case and why you need to spend funds there, and then the approval can be sought.
Okay, sir. Next question, sir. What is the time limit for receipt of remittance for export of services like software development?
So the general time limit given for export is 9 months. So that is the time limits which are applicable to each and every case.
Okay, sir. Next question, sir. And it is the last question, sir. If an advance against export is lying in books since more than 3 years, then can it be refunded to that customer? If yes, then what is the process for that, sir?
So you can refund the amount, and you can also pay a certain interest over the amount because of a delayed refund maybe. That is also permitted. The maximum amount they have, if I'm right, is maximum is LIBOR plus 100 basis point. And in case the amount is lying in your books for more than a year, then in that case, the refund would require a specific approval from the Reserve Bank of India if it is beyond 1 year, citing the reason why you did not refund the money earlier. It may be due to financial difficulties, it may be due to other factors also. And that once the approval is received from the Reserve Bank of India, then you can actually remit this money back. However, in case you have obtained any export incentives on that advance which you have received, you'll be also required to refund that export incentives before you refund that amount.
Yes, sir. If you permit, one more question.
Yes, sir. Please go.
Taking the time into consideration, sir. Whether FCTRS need to be filed in the case of NRI bought the shares in Indian company by paying from NRI account or remittance brought from abroad.
Sir, Jain Saab, इसमें actually there is no NRE account. It is either NRE account or NRO account. So I'll answer both for both. In case of NRE, it would be required generally. In case of NRO, it may not be required because there is a concept of in case he's a non-resident Indian NRI, then in that case there is a concept of investment on a non-repatriation basis. So that may be applicable to such a scenario, and it may not be required in such case.
Thank you very much, sir, Speaker sir, for such an informative and wonderful presentation and deliberation on a very challenging and formidable subject, sir. Speaker sir covered mostly all key challenges, key audit tests, key audit procedure and processes, key focus areas where the auditor should focus while auditing. May I over to Anil sir. Thank you very much, sir.
Thank you so much, sir. Thank you so much, KK Jain Saab, for question answer session. You have covered in a very efficient manner. From the core of my heart, I extend my heartiest thanks towards today's speaker, CA Lokesh Gupta ji, for in spite of having his busy schedule as well as his personal commitment today. Sir, today is his marriage anniversary. Wishing you a very, very happy marriage anniversary.
Thank you, sir. Thank you so much.
Apart from having his personal commitments, he has given me this opportunity for the members that he will surely speak on this today topic. So thank you so much, sir, for giving us this precious time as well as your expert knowledge to all our members. Thank you so much, sir. And thank you, our today's moderator, Shri KK Jain ji and Ashwani Jindal ji in his absentia for taking out time for our today's webinar and moderating this webinar, and you have also spent complete more than 2 hours with us and successfully completed today's webinar. Thank you so much, KK Jain sir. Thank you so much, Ashwini ji, in his absentia. Thank you, Lokesh sir. Thank you so much.
Thank
Thank
you,
you,
sir.
sir. Thank you.